Hello, this is Coach Mike from winningstockcoach.com. Going to start out with my weekly market overview video for the upcoming trading week, the week beginning March 2nd, 2015. Another month has come and gone, and we will be starting the first trading week of March. So basically, over the last couple weeks, we saw a little bit of a breakout from our weekly swing high point as we start here on the SPX, the S&P 500 chart. This past week, it was going pretty strong until midday on Thursday and kind of pulled back a little bit. Remember what I had said the past couple weeks that, you know, everything right now kind of resolved or kind of really relies on the support point of 2088.77. One thing that we just can't overlook is this continued bull market. I mean, one day it will come to an end, but people have been saying that for 2-3 years, and it keeps going up and making all new highs, which we saw again this past week. So right now I'm going to switch over to a daily chart. Just going to look at a 6-month daily chart. One thing I use for the target points is the Fibonacci extension tool, and just looking at this little bit of a dip it made a week or so ago and into this high, it's actually very possible that Friday we pulled back and might continue right along upwards come Monday. That's very, very possible. So I want you to keep an eye on value, 2104.80, within 0.5% of that if it were to make a positive move. If it were to make a positive move, then as we go back to our weekly chart, we talked about, hey, 2231.37 might be a long-term swing target that the S&P could see. As far as any negative type move, again, we need to really focus on that support level 2088.77. Until that fails, you pretty much need to look at any pullback that doesn't fail that and maybe bounces off of it as an opportunity for the next upward swing. And sadly too, if you get a little bit of a down move below it, I think we really got to kind of watch around 2051, maybe this 2035.87. I think, might get a wick down that touches it, or if it got crazy about 2007, 2008. But I don't think that would be any more than a wick unless the markets were really getting ugly. So if we start to make a downwards move, personally, I would avoid shorting unless that 2088.77 level is broken below. And any short position that I would take, I think you need to keep a little bit of a short-term mentality. You might only be in it a few days, maybe a week at the most, and a couple weeks. If you're still in it, it's probably because the markets aren't moving very well, and it could present more danger to you than you might be willing to take. So I would have a kind of a shorter time frame focus on short positions if we were to continue to pull back. The way things traded late in the day on Friday, it's kind of hard to determine if it was just maybe an end of the week and end of the month sell-off that resulted in quite a few bearish chart patterns on a lot of stocks that I watch, or if they were actually a legitimate sell-off. So there's just a little bit of wiggle room, not a whole lot to the downside before we'd get a confirmation on that. So I think we've got a very, very important task ahead of us the first day or so this week to see if any pullback really extends below that prior weekly swing high point, which, we've gone over and over. If you follow the series of videos I put out each week, we've gone over and over about the reliability of these weekly swing points and how they've caught our prices on pullbacks. So, it'd be hard to overlook that as a possibility for either one of those, whether it be that month-long consolidation we had here in January or that swing high point from the end of December. So again, just to reiterate, if you're taking a short position, I would also have a shorter time frame focus on how I was trading that, especially if I was trading via options and taking puts for a downwards move. I don't think I would want to overlook the possibilities of support level bounces after getting a higher high. Moving over now to the DJI, that's the Dow Jones Industrial Average, a 30 stock composite. Um, Looking at it overall, same type of deal as the SPX. We, a couple weeks ago, were able to make the break of the weekly swing point. And actually, this past week, if I zoom in here just a little bit, you'll see that this lower wick actually bounced right off that weekly swing high point. So, even though it's a doji candle for the weekly, some people think that a doji candle means you will reverse. I like to think of it as a statement by the chart telling me to watch the next candle, because many times you get a doji candle right in the middle of a run. It's not a reversal sign. It's actually sometimes, if you're going to have a volatile up move, you'll actually have a doji candle in the middle of that up move as it kind of regains strength before it pops again. For the week, we did have a bit of improved volume traded in the DJI, but improved volume that basically was inconclusive due to that doji candle. Would I be surprised if it pulled back a bit? Absolutely not. Would I be surprised if it went up? Actually, I would not at all. So I think the key again is that weekly swing high point. And you can see this weekly candle with me zoomed in on the chart, and I can zoom in a little closer to help you out. You can see our weekly swing high point is 18,053 and 71 cents. And for the low, it might seem to simple minds like we didn't come close to it at 18,132.70, but that's a very minuscule percentage difference. I mean, that's like 1 cent on an $18 stock, if you really think about it, that we came from retesting that swing low or that swing high point. So if we were to make a positive move from this point, it would actually be pretty well warranted. I think that right now you use that swing high point, that 18,053 and 71 cent, as your support level. If we happen to make a fail or make a pullback below that, I think that right now, after a higher high, you'd have to look at the possibility at a higher low, probably around 17,441.25. But if we just really keep going up after bouncing off that swing high point, we're going to look at a longer term target, a 19,286.09. I say longer term because I don't think it would get there before May, maybe before the summer sell-off, if we even get a summer sell-off. Last year we didn't. So that would be something that I would be keeping my eye on. Going to move over now to the RUT. That's the Russell 2000, the small cap index. Last week I said that I didn't believe there was that much room between where we were and where my target point of 1238.23 was. You could say, oh, you missed your target, but I'd say being within 0.5% of my targets for 52 or 53 consecutive times now, which the video series would prove. I'd say that right now, that advisement last week to not have any new small cap entries for longs was fairly decent. You can see by the weekly candle, it was a bit of a rocky week. Not quite a doji candle, but we got just as much upper wick as we do lower wick. That means we bounced around between a pretty consistent range. We can see that here on our daily. Even though we had several up candles, we pretty much gave, here would have been Thursday, your biggest up day, Wednesday, Tuesday. We pretty much gave up Tuesday, Wednesday, Thursday's move all on Friday. So looking at that, I think if we did pull back from this point, we would see around 1169.52. The Russell 2000's been trading a little bit goofy, but starting to make an up run after really 2014 not being pretty for small caps until the end of the year. So I'd keep an eye on that opportunity. If you see the RUT back in this 1169.50 area, I would probably advise you to start looking at those small caps. I think there's still some good value in small caps. I think not right now, but if we saw the RUT around there, small caps like Yelp, YELP, or Zillow, Z, two of the larger small caps, that those would be quite nice or quite nicely valued and would probably look fairly good or fairly appealing on the chart, at least for a defined risk via options trade opportunity if we were to get down into that point. So right now for the RUT, I think you have a little more room to short if it does start pulling back. If you see the S&P, the DJI really moving into that swing high point that I discussed on their charts, I think you have a little more room for maybe even a day trade on the short side. You could, do that with the IWM, the tradable ETF for the Russell 2000, save you a little more money on the option prices for puts. But quite literally, I think I'm going to go into this with the same plan I had for the big boys, which was being very, very cautious on a pullback that might just hit that swing high point. And based on the reaction I see from the S&P 500 and the Dow Jones Industrial Average, if we fail that swing point, then I would look to enter short positions. A lot of people think trading's about trying to get the absolute lowest price and the absolute highest sell. Those people usually don't do well trading. Trading is about being consistent, and if that consistency means maybe buying at a little bit higher price, but once something is confirmed as being a higher probability of producing a winning trade, then it doesn't so much matter that you might not have got the lowest possible penny buy when your winning percentage per trade entry is much greater. Finally, going to go over here to the NDX, NASDAQ 100. Had that momentum and breakout play last week. Another doji candle, not really a lot to go off of. I'd say the biggest part of this is the fact that 13% of it is Apple, and Apple really played around with the weekly target I had. It did break it a little bit, and I told members of the coaches roster in our chat room very early on Monday. I had somebody ask me, he's like, where can Apple go now? And I said, well, after exceeding my 129.40 target, I figured it was trading purely on momentum, and said very early Monday I thought I could hit 134 and 127 in the same week. Well, if you followed Apple, it went up to 133.60, so I was 40 cents off. And then it fell down to 126.61, so I was 39 cents off. So basically, I was 40 cents off my up move, but the down move gave me that 40 cents back. So, it was just purely a momentum trade. And when the momentum was gone, it fell pretty hard. And I think if Apple were to continue downwards, which, sadly at this point, it actually looks like it will, I wouldn't be surprised for the NASDAQ 100, the NDX, to pull back around 42.66. The big thing, if you follow the news lately, they're talking about how the NASDAQ hasn't been up here since the tech bubble. And so you're getting all of those bearish yahoos that come out and, they say it every time that it makes an up move that, oh, it's going to crash. And, eventually it might. Actually, eventually it probably will. But those yahoos have been saying that for a couple years, causing many people to miss out on a lot of opportunity. And, I think at this point, even that stock crash back in 2008, also back in 2001, they both gave indications on the charts that the up moves were over. People just ignored those. So I would anticipate that the charts would, again, not just directly make a crash, they will give you an indication beforehand and then crash, and it'll be up to you to see that indication. So right now for the NASDAQ, I think if Apple continues to pull back, you're going to see this fall into that 42.66 area. And if you see a bounce from there, that'll probably be about the time that Apple hits, I'm going to say about 123.50, and maybe if you're lucky about 119. And if you see that, get your money out and prepare to buy Apple, because if you have a good option strategy to trade around those common shares, you don't really have to worry about much to the risk side. And, Apple's proven itself to be a solid one to own. So basically a recap on the expectations for this week. I'm going to go back to the SPX chart and just want to say that this last weekly swing high point, 2088.77, even though I believe it's fairly likely that we pull back and hit that, I don't have an intention to trade for that. I'd rather see if that could fall below and make a shorter time frame short trade opportunity down into this 2035 to 2050 area. The reason I don't want to take the short trade into this swing high point is very, very simple. The reward side of any trade you'd look at that were to only hit this point and bounce up is going to be far outweighed by the risk that you just take off to the upside and take a very heavy loss. Therefore, I'd rather wait till there was a higher probability where the chart defined a clear stop point for me and then take advantage of that. So, you know, depending on where we open up on Monday, it could be a little bit slow to start the week. And after that, I think you'll see the opportunities present themselves, whether they be long or short opportunities. And again, just because you go down doesn't mean the market's crashing. It could just be the opportunity to enter long positions. This is Coach Mike from WinningStockCoach.com, wishing you the best of luck in your upcoming trading week, and God bless to all of you.